Welcome to the Daily Brief, where I'll go over the highlights for the action in the market for Thursday, November 17th, and then see how things look for Friday, November 18th. We had another down day. It was actually kind of positive. We put in the low right at the open or shortly after the open, and then spent the rest of the day clawing back. That's helped a little bit to work off our specifically short-term overbought situation. We're still a little bit short-term overbought, but it's working off some of the other indicators that we've seen. And we pretty much have worked off the intermediate term overbought condition. So that could be constructive. However, we're getting to the point now with a couple of down days in a row where now we need to make a stand. By we, I mean the market needs to make a stand. If we're going to go up from here, if things are going to stay positive, we need to have a positive Friday, basically, or things are going to switch back a lot more negative. So let's go back and talk about what happened. Right at the open, we had a gap lower. That is mainly being attributed to some Fed speak that I'll go through here in just a moment that the market really didn't like. So that pushed the futures down. We had a negative open. And because Wednesday's session was so tight between the high and the low, the spread, the pivot levels for Thursday's session were not very far apart. And you'll see that when I get to the chart. So usually S3 is not drawn on the chart that I use, so I had to put that there myself. But we gapped lower down to S3 at 39.08. So we're kind of hitting that 3,900 level again, where just recently we've been dealing with the 4,000 level. We saw a slight bounce right after the open, and then a retest of that level, came right back down to it. As the day went on, prices recovered, and we got almost back to the unchanged level. Not quite, but almost. And then we fell down below S2, which was at 39.37. And then we bounced a little bit from that. We closed near S1 at 39.48. So we're roughly right in between 3,900 and 4,000. We were down 0.31% on below average volume. And the volume on Thursday was even less than the volume on Wednesday. That could be seen as positive because as we've been going down a little bit now, we're seeing volume really tapering off. If we have some kind of an up day, we'll want to check out the volume to see if it's increasing. The technicals, they're still positive overall, but as I said, we're kind of at that tipping point now, a little bit more weakness, and it could switch some of our things negative. And inflation and interest rates and Fed speak, that's the real focus right now. And we're still having the issues with Russia, and it's still coming out, except I understand the president of Ukraine is saying, no, that was not a mistake. It was a Russian missile. Well, a lot of other reports are saying it was Ukraine who shot the missile, and it just went in the wrong direction. And then I've also added another one here, North Korea. Now, they're always kind of in the background with some concerns, but apparently they shot a missile that landed not too far from Japan. So that can produce a pretty unsettling situation as well. Here's the chart where we gap down, and here's S3. And this acted as pretty good support right in here. We came down to this level, went up a little, came down, tested it again. And then from there, we're able to recover. We didn't quite get back to this dash line, which is the unchanged level, before falling back down below S2 and then closing just about at S1. And you can see how close the pivot levels are because they're based on Wednesday's price movement. So this is actually a little bit more positive. You could say, if you just took this intraday chart by itself, we closed pretty much at the high, just a little bit lower than the high, because we gapped down and then spent the rest of the day getting better. So that is a little bit more positive. At least that's the way I view it. Even though we were down on the day, we had a bad open, we did recover some of that as the day went on. What are some comments? St. Louis Fed President Byrd, who we've talked about before, who's a voter, acknowledged that the Fed funds rate is not yet at a sufficiently restrictive level. That means we might have to raise these rates even a little more. And then he used this thing called the Taylor rule to demonstrate this. This is a formula that takes into account inflation and what they think GDP should be and what GDP really is and the difference between the two. And they crunch these numbers, and they suggest that the Fed may need to go anywhere from 5%, which has kind of been the working level for, maybe that'll be the terminal rate. But then he threw in another scary number there, up to 7%. So the market didn't like that. And that's being attributed a lot to the negative open that occurred. And then the Kansas City Fed, President George, who is also a voter right now, said that a real slowing in the labor markets, and we've been talking about this, and a contraction in the economy may be needed to reduce inflation. That's why the Fed is justifying what it does, because the employment situation is holding up. We're not really seeing a lot of weakness. Now, there are some little trickles coming through. We're starting to hear about more layoffs. We're starting to get a little bit more of an increase in the continuing jobless claims, not only the initial ones, but the folks that are on unemployment for an extended time. They're starting to show a little bit of growth right now. And that's more indicative of really what is the employment situation like. But we're not at the point yet where people are really noticing this or figuring that into their, where do we go from here as far as interest rates, specifically with the Fed. It's still just too strong. We did have the small caps really underperform in Thursday's session. The daily equity put call ratio, after it really spiked up on Wednesday, well, it really came back down in Thursday's session. The dollar was stronger and interest rates rose. So that's been providing a headwind for stocks. And on the short term, we still have the rate of change looking back 10 periods. That's still pretty extreme. Some of the stochastics, our shorter term stochastics, are working off, and a bit of our intermediate term, but then our longer term stochastics. And please be reminded that that whole stochastic study that I show, short, intermediate, and long term, I treat that all as a short term indicator, even the long term stochastics, maybe a little bit over into the intermediate term, but they move pretty fast. Even the slower ones move fast. So I kind of group them in the short term area. They're working off some of these conditions, and that's kind of the word of the day, or the two words of the day, is working off. That's what appears to be happening after being extreme positive. Intermediate term, we have the rate of change 20. We still have the BPI that's coming down a bit. The PMO studies, the shorter term ones, they're working off being extreme positive. And the 100-period moving averages, both the exponential and the simple, that was the low that we set. We came down to that level and then bounced up off of that. And I have some charts to show you that. And then the 30 to the 5, yeah, it's back being inverted again. After spending a few days in regular land, it's gone back to inverted land now. Sentiment is still positive. It hasn't really changed all that much. We're still leaning over towards the positive side of things. And we had housing starts come out at 1.425 million. They expected 1.420, so a little bit more than expected, but it's not really growing with any robustness right now. The last time we had this, it came in at 1.488. So a little bit of a decline, but a little bit better than expected. Building permits, which can be used as a leading indicator, because you have to get the permits before you can start building. They came in at 1.526 million. They expected 1.518, a little bit more than expected. The last time it was down a little bit from 1.564. So again, not really showing a lot of growth, but coming in a little bit better than had been expected. Jobless claims were as expected. And then last week they were at 226,000, so declining a bit. The Philadelphia Fed Index, which I forgot to mention in yesterday's video, it came in at 19.4, much weaker than expected at -5. The last time we got it, it was -8.7. That's, again, as the names should suggest, in the Philadelphia area. But still, we want to keep an eye on these things. Our trend is still neutral, but it's starting to turn down now. After having a couple of down days, the ADX itself is starting to roll back over. It hasn't quite crossed back below the moving average, but it is starting to show some weakness. I've switched our bias to mixed right now. I still see the positive backdrop behind us. It's still hanging in there, but we've had 2 down days now. And the momentum, I'm also keeping at mixed because we're kind of getting to that tipping point now. If we have another down day like we had on Thursday, we're going to switch back more negative. If we have an up day, that will be able to resolve what we're seeing under the surface and look a lot more positive. Here's the chart that I'm just going to keep showing, even though now it's a week out of date, where you compare the price action in 2022 to back in 2006 through 2008. And it just shows that right at the end here, if we really stick with what has been happening, we could see some weakness going into the end of the year. At the same time, there's some different dynamics that are playing right now. We have positive seasonality. We've gotten beyond the midterms. We have the year, the presidential cycle, and things like that could give some support to the market. Then we also had the weekly survey of individual investors after being extreme negative or very pessimistic. They're back more, looking a little bit more positive now. So that is showing a little bit of improvement, but it did come down a little bit from the previous week. Here is our trend, seeing how, and it might be really hard to see, the dark black line there, the heavy black line, it's starting to roll a little bit back over the moving average. It's not quite there yet if you look at it on a bigger chart, but it's getting close. The green line is still on top, but declining. So overall, this trend is weakening. We're going to need to see some upward movement for this to turn back more positive. Here's our daily chart. And if, again, it might be a little hard to see, the bar itself, it looks pretty positive. Where we opened, that's the wick on the left, and then went down a little bit, but then ended near the high. That's a pretty positive bar, even though it was down overall. But we're still dealing with this idea that maybe we came up to R1 and are starting to come back down. We'll need to see, are we going to continue to fall from here, or are we going to be able to get some more support and go back closer to R1, if not actually break through it? Because we're right in between the 50-period moving average and the 200-day moving average. And then at the bottom, you can see how volume really dropped off. We're well below average. Here's the 100-period simple and exponential moving averages. They're kind of on top of each other, but that acted as support. And here's our moving average tree. Also, here's the 100-period moving averages right here. We hit the 200-day exponential average a few days ago when we hit that high, and we've been battling with that ever since. So we just, again, want to keep an eye on this. If we do see prices go up higher, can we break through the 100-day exponential moving average? If we fall, then we're going to lose the 100 support and then start coming down into the 20s and the 50 moving averages. Here's our fib retracement after we spiked up here, coming back down, and we're just about, well, we're above this other fib retracement. But if we start to fall, that could also produce some support. And if we break through it, that could make things switch much more negative. Here's the equity put call ratio, where it really spiked up on Wednesday and really came back down on Thursday. It hasn't really fed into our 5-period measure of the equity put call ratio, at least yet. It just shows it going up, but not spiking. New highs, new lows, no real change here. I just wanted to show that internally we're still hanging in there. We're not really seeing an expansion of new highs or new lows. So our 5-period moving average continues to go up, and we're turning up slightly with the 10-day as well. This is a warning sign that I pointed out in yesterday's video, where we're still going higher for the most part based on price with the summation index, but we're turning down based on volume. These two indicators are calculated differently, and sometimes the volume will give us a little bit of a lead as to what might happen. So what's our outlook for Friday? The technicals, they're weakening. You can't have 2 down days like we've had and still stay positive. as positive, but we're positive overall. The short-term overbought situation is working off. There's still a little bit of the intermediate term that's working off as well. We have existing home sales coming out, and the leading economic index will be coming out. And then all the geopolitical events, the markets are still, we'll have to see if we get some Fed speak during Friday, because that feeds into the inflation and interest rate scenario. We're keeping an eye on the North Korea situation. Haven't heard anything lately coming out of the Iran-Saudi Arabia situation. But like I always say, in addition to earnings that are coming out, any one of these could come into the forefront and have an impact on the market. So our scenarios, not really going with the down scenario, even though the technicals are weakening, we're still positive overall. Our slope oscillator is kind of starting to turn negative, but all of our other oscillators, they remain positive as we continue to try to work off this short-term overbought condition. Positive, we're kind of going with that, but we're not seeing any confirmation with price. We need to, if we fall, hold on to support. If we go higher, we need to break through resistance. So we're still going with the sideways scenario currently, because the ADX, it's weakening and below 20, but the green line's on top, so it's still positive. So our conclusion, the S&P is weakening, but it's still positive overall. If we don't get a good day on Friday, we could lose that. Short term, it's weakening, but still positive as the overbought situation is worked off. It's intermediate term positive, but again, showing some weakness, and we're still negative with the long-term trend. So have a wonderful Friday. I will do what I can to prepare the videos that I'm able to do over the weekend. Just bear with me on that, and I appreciate your patience. I'll at least post a brief video. I'll see if I'm able to do any of the other videos. So have a great day, and I'll talk to you in the next video.